Hello everyone, welcome back to my channel. So this video marks the end of the week number 33 in this Road to 100k Realized Return Challenge. It's been a very busy week. There are many things to touch base on, and this week started out with a bang, as you know, because markets just crumbled down on Monday and they were also slightly low or slightly down on Tuesday, but then it came a slightly favorable report on inflation, both on the headline and on the core side of inflation, and markets recovered a little bit on Wednesday before coming down again on Thursday, and just as has been occurring in the past few weeks, it just skyrocketed again on Friday, on yesterday. And as you can see here, the Nasdaq recovered and went up 2.57%, even though of course the QQQ, which has slightly different weightings to the Nasdaq index, went up just 2.31%. However, the main topic is that we bought 400 more shares on Pfizer because the puts that we had sold were assigned. The puts, if you recall, had a strike price of $26, as you can see here. Yep, here they are. So there were 4 put contracts sold and they were assigned here, as you can see. So we bought 400 more shares at a strike price of 26, and so now we have an average price of $26.36. So that means that we will have to continue to sell calls on Pfizer, at least with a strike price of $26.50. Now, as things stand at the moment, and given the current price level of Pfizer, given that they closed down at $25.74, the only thing that we can do at this point is to sell calls at a strike price of $26.50, because that's as low as we can go. It would be nice if the stock recovers a bit on Monday during the pre-market trading, so that we could try at least to sell these calls at a slightly higher strike price, for example 27, but I'm not seeing that happening. I think that's highly unlikely, and so most likely we will have to settle for the 26.50 call, which is a pity, because last week, as you can see here, if I show you the weekly graph for Pfizer, the stock went up by a lot over the early minutes of the Monday trading session. It went up all the way until it went past the 27 mark. That's why we sold calls on 27.50, and if we had sold our shares right then, it would have been a nice profit. But yeah, there's nothing we can do. The stock, as you can see here, just plummeted the next few days and never really recovered towards the end of the week. So as things stand, and because we cannot afford to keep we cannot afford to not earn any premium or any return on these shares, we would have to sell the calls at a strike price of 26.50, and then we'll see what happens. Another interesting story this week is that because we applied our strategy that I showed in a previous video, and basically we managed to get a quite good performance this week. As you can see here, I've already posted basically the numbers in our scoreboard, and if we take this number out, because this number is just a mark-to-market number, 26 cents, meaning the difference between the strike price, or the price at which we bought the shares, and the stock price at which the Friday session ended, which is irrelevant because on Monday this number will be different, and so the loss will also change. So assuming, let's just take this number out here, and as you can see, and we just managed to get let's just put here 0 because we still managed to keep the premium of the call, all right, of this put. And so if we add all of this, we managed to crack $1,100. So we managed to earn over the course of a week slightly more than $1,100 for the entire week, which is a very, very positive outcome for a week. And that was due for the most part of having to roll over a lot of times the calls on QQQ. Just to give you an example over here, and this happened on Monday, we started by selling a call with a strike price of 590, which we bought back as the price continued to drop down. Then we sold more calls with a strike price of 582 in the middle of the session on Monday. We also managed to bought them back at 1 cent, and then before the session ended, we managed to sell another call, 3 more calls with a strike price of 576. This was simply because the price was plummeting down so much that the calls were simply becoming worthless after very, very little time. As you can see here, we sold these calls as soon as the market opened at 3:30. So this is Central European time. We bought those back at 6:42, and immediately we sold a few more at the same time, 6:42. And again, by around half an hour before the end of the session, we bought those back, and we still managed to sell a few more. And this one also expired worthless, as you can see right here. And we managed to do the same thing here, as you can see on Tuesday. We managed to do the same thing. We sold calls first on Tuesday with a strike price of 585, as you can see here. Again, because this was at 2:33. So basically, this was because the change of the hour in the United States. So the stock market now opens an hour earlier, and by 6:56 we managed to buy these back because they were already at 1 cent, and then we immediately sold another set of options, another set of calls with a strike price of 578, which basically expired worthless. Now for the week, for Wednesday, I mean, again, we did this exact same thing. As you can see over here, we basically rolled over the QQQ calls again. We sold calls with a strike price of 589. Later in the day, we bought those back here because they were already at 1 cent. This was at 8:34 p.m. So about half an hour, 45 minutes before the markets closed. And then we sold another one at 581, which expired worthless again. And then on Thursday, we managed to do a slight error, which ended up costing us some money. It cost us $74. So this was the actual loss that we had, but the reason was very simple, and it's easy not to repeat this mistake again. What happened was, let's see where it starts. So it starts here. So we sold at our first calls at 480, right? We bought those back at 658, so about 4 hours later. We sold more calls immediately after with a lower strike price, 474. And then if you take a look here, at 8:52 p.m. so Central European time, again, the issue was I was under the impression that the market would close in about 8 minutes. It would close at 9 p.m. And why is that? Because before, the market used to close at 10 p.m. before the change of the hour in the United States. And so it was my understanding that the stock price would close at 9 p.m., which eventually does, but with a slight difference. The stock market closes at 9 p.m., but the ETF market, the shares of ETFs apparently continue to trade up until 9:15. So, and this 15-minute extension proved to be our downfall in this situation. And why is that? Because at the time the price was hovering around 468, 467, but it was mostly 468, and I felt, all right, in 8 minutes it's not going to change that much. Actually, I think it was 457, and so I decided, all right, in 8 minutes the price is not going to change that much. There is not enough momentum, and so I decided, all right, let's sell another ones at 470 because there's only 8 minutes left. However, I saw that once 9 o'clock hits, the stocks and the options on stocks stopped trading. The market closed, but the ETF stocks and the options on ETFs continue to trade, and that was enough for the price starting to climb, and eventually it hit 470. In the last few minutes, 9:12, 9:13, 9:14, the price was hovering around 470. A bit up, a bit down, always like a pendulum. And because of that, I decided, all right, we cannot afford under any circumstances these calls to be assigned, because if they do, we are going to have to realize a loss of about $19,000. And so at 9:14, I decided, all right, we cannot afford to take this risk. Let's just take the hit, this loss, and keep the shares. And so basically, a few seconds before the trading session ended, we bought these calls back at a loss because we had to, and that's why we have this loss right here. Now, if I knew that the price was still at 468, around 468, and we had still around 23 minutes of trading time left in the session, I would either use the slightly higher strike price, or would not even closed this trade, so bought back these calls at 474 at all, because there was enough time in the session for the price still to come back. But we learned with these mistakes. Now we are aware that the market closes on at 9:15, and so for sure, barring exceptional circumstances, this will not happen again. Now for Friday, it was business as usual, albeit with a slight scare, because here the market skyrocketed, and there was a point in time on Friday that the price hit 480 and a half, as you can see here. And I'm going to show you the chart. Right, and I'm going to show you here the chart, and as you can see here, and if you look here at 1 day, you will see that there was a high here at 480.56, so just below our strike price. And there was also another moment of scare here at Tuesday. As you can see here, this is Tuesday. There was a point in time in which the price of the QQQ shares hit here around, as you can see here, I'm going to push this here, and as you can see it went to 478 here. But, and as you can see here on Tuesday, and here the 11th, yeah, we managed to have calls at 478. So these calls, for a brief moment in time on Tuesday, they were in the money. However, fortunately, right here, but fortunately the situation simply was diverted away, because the stock can then continue its trajectory back, and this pullback ended up not costing us. But it was a moment of scare, because otherwise we would have basically to buy back our calls, but it ended up not going to fruition. And so the tactics of consistently selling the calls, rebuy them as they reach almost a worthless value, and then rolling over or meaning selling back other calls. This is something that, as the market goes down, and as long as you set your strike prices correctly, it should give you additional profit. And it was an instrumental way that it was instrumental for us to reach this result for the week. $1,105.26. Now, sometimes this can backfire. Of course, in this case, it was simply because I was not aware that the market for the ETF options and the ETF shares would close 15 minutes later than I thought it would, but this for sure would not happen again. And as you can see here, as the market skyrocketed on Friday, there was no way for us to basically buying back these calls at 481, because as the markets continue to go up, these options never lose value, never lose much of their value. They only lost their value at the very end of the session, when there was no way the price would climb back up or to be much close to the strike. And so, because the options were always with value, we always had to keep them and not being able to bought those back and selling additional calls. So yeah, as things stand, it was the way it happened. It was still a good trade because we still managed to profit $141 just on this trade. Even though, of course, despite the fact, besides the fact that we still managed to collect most of the profits of this recovery from the Nasdaq. But yeah, next week, if this value of $479 for the QQQ stock price remains, we should be able to sell the calls again for 1 day only, and we should be able to sell them with a strike price of 490, something like that, assuming a 2.5% appreciation. Yeah, it should be around 490, 491. So this should be our target strike price for next Monday, assuming the stock price remains this way during the pre-market trading. And of course, for Pfizer, we will have to sell the calls at 26.50 to make sure that if the strike hits, at least we make some money out of it. But one last thing, now this report will not give us the full picture, because this was the activity statement still with the trades that would expire on Friday still to close. But as you can see here, March 14, and if you look again to the realized profit, as you can see here, it's 32,373.93. Of course, given the fact that we still have this call of QQQ to become realized, because they expired worthless, all right, so it still had some value. And the call on Pfizer, the 26.50, that ended up expiring worthless, and the loss, unrealized loss, which of course will go down to zero because we didn't pay anything else other than the cost of the shares, so the premium will keep it. And yes, and as you can see, and one thing that I failed to mention is the fact that because we initially sold calls on Pfizer for the strike price of 27.50 here, as it became apparent that the strike would not be achieved anymore, we simply bought back these calls, as you can see here, and then we sell another ones, of course with a very small premium, because that was the only option left, at 4 cents a piece for the 26.50. So we basically rolled over our calls, we did not let them expire worthless, and then we rolled over to get some more premium out of it. We still managed to get $96 on top of it, minus the commissions, of course, but still it was a good result. And as you can see, they were not sold. We kept the shares because the calls expire worthless. Now, this is it, and this is the plan for next week. Let's hope that next week is a bit more positive and picks up the momentum which came back from last Friday. Next week we'll have the FOMC, the Fed meeting, and even though the interest rates are expected to remain the same, some guidance for the next month in the aftermath of the latest inflation report and the economic conditions in the United States should be something to be consider, since that all plays into the Fed's decisions for the coming meeting. For the time being, this is all, and feel free to leave your comments, your questions in the comment section below. I'm also available on LinkedIn in case you need to send me a DM with questions, and also, of course, feel free to like the video and subscribe to the channel, and we will reconvene next Monday to start the week number 34 in this challenge, and I'll see you there.